Here's Thomas. Thomas worked hard, saved diligently, and kept his money in a regular savings account for 40 years. At the end of those 40 years, Thomas finds that his savings have amounted to a solid sum, but he isn't satisfied since he feels he lost some of it due to inflation. Now meet Lucas. Lucas also worked hard, but instead of just saving, he decided to invest his money. For the same 40 years, Lucas put his money into stocks, real estate, and other assets. When he looks at his investment portfolio today, he sees significant growth, thanks to the power of compound interest and the market's appreciation over time. So, what's the difference? Thomas was saving, while Lucas was investing. Today, we're going to dive into what you need to know as an investor. Let's start with some key concepts you have to master. Investing is the act of allocating resources with the expectation of generating an income or profit. It's about making your money work for you by putting it into various financial vehicles like stocks, bonds, real estate, or even your own education. Investing can be broadly categorized into long-term and short-term investments. Long-term investing involves holding on to your investments for several years, even decades. The goal here is to benefit from the overall growth of the market over time. It's about patience and letting compound interest do its magic. Short-term investing focuses on making quick gains over a short period, usually within a year or less. While it can be profitable, it often comes with higher risks and requires a lot more attention and knowledge to time the market correctly. One of the most powerful concepts in investing is compound interest. It's the process where the earnings on your investments start generating their own earnings. For example, if you invest $1,000 at an annual interest rate of 5%, after the first year, you'll have $1,050. In the second year, you'll earn interest not just on your initial $1,000, but also on the $50 interest from the first year. After 40 years, your initial $1,000 would grow to $7,000. This exponential growth demonstrates how powerful compound interest can be over the long term. When it comes to stocks, you have two main ways to earn money: dividends and capital gains. Some companies distribute a portion of their profits to shareholders in the form of dividends. This provides a steady income stream, making it an attractive option for those looking for regular income. You can choose to receive your dividends as cash, providing you with regular revenue. Alternatively, you can reinvest the dividends to buy more shares, which can increase your investment's overall value and potentially generate even more dividends in the future. With time, you could build a portfolio that generates enough dividend income to act as a salary, providing you with monthly income. On the other hand, you can hold on to your stocks in the hope that they will increase in value over time. This is known as capital appreciation. While this doesn't provide immediate income like dividends, the potential for significant growth can be much higher. After mastering all those key concepts, you will have to define your investment strategy. Having a clear strategy is essential for successful investing. Here are the key components to consider. Start by defining what you want to achieve with your investments. Are you saving for retirement? For a down payment on a house? Or maybe you are building an emergency fund? Having clear, specific goals will help you determine your investment timeline, risk tolerance, and the types of investments that are right for you. Once you've defined your goals, create a strategy to achieve them and stick to it. It's easy to get swayed by market fluctuations or hot stock tips, but changing your strategy frequently can lead to poor investment decisions and lower returns. Always remember, consistency is key. Do not try to beat the market. Many new investors make the mistake of trying to time the market or pick individual stocks that they think will outperform. But the truth is that even professional investors struggle to beat the market consistently. Instead, focus on long-term growth and broad diversification. Accept that there will be ups and downs, and stay committed to your strategy. Use dollar-cost averaging. It is an investment strategy where you consistently invest a fixed amount of money at regular intervals, regardless of the market's performance. This approach reduces the impact of volatility on your overall investment and takes the emotion out of investing. Over time, you'll buy more shares when prices are low and fewer when prices are high, potentially lowering your average cost per share. Building a diversified investment portfolio is crucial for managing risk. Your portfolio should include a mix of asset classes such as stocks, bonds, real estate, or index funds. Diversification helps protect your investments because different assets perform differently under various market conditions. Here are some tips for constructing a strong portfolio. Decide what percentage of your portfolio will be allocated to each asset class. This depends on your risk tolerance, investment goals, and time horizon. Choose investments with a solid track record and strong fundamentals. Avoid chasing high-risk, high-reward opportunities without thorough research. The most important part of investing is risk management. Here are the key principles you must always keep in mind. With high and fast returns come high risks. Investments promising quick, substantial gains can also lead to substantial losses. Balancing your portfolio with a mix of high and low-risk investments can help manage this. Diversification is key. By spreading your investments across different asset classes, sectors, and geographic regions, you reduce the impact of poor performance in any single investment. Here's how to diversify wisely. Include a mix of stocks, bonds, real estate, and cash in your portfolio. Invest in various industries, such as technology, healthcare, finance, and consumer goods. Consider investing in both domestic and international markets to spread your risk globally. Diversification helps ensure that the positive performance of some investments can offset the negative performance of others, leading to more stable overall returns. The lower the risk, the better you'll be. Here are several strategies to lower the risk in your investment portfolio. Include investments that are less volatile and more stable, such as bonds, solid ETFs, or blue-chip stocks. Thoroughly research any investment before committing your money. Whatever your decisions are, they must be informed. Maintain an emergency fund separate from your investment portfolio. This ensures you have liquid assets available for unexpected expenses, reducing the need to sell investments at a loss during market downturns. Understand your own risk tolerance. Be realistic about how much risk you're willing and able to take on, based on your financial situation, investment goals, and time horizon. The crucial step is to actually just start investing. Don't wait for the perfect moment or the perfect amount of money. Even if you can only start with small investments, the key is to get into the habit of investing. This not only helps you become more comfortable with the process, but also allows you to gradually increase your investments as you gain more confidence and resources. Remember, the earlier you start, the more time your investments have to grow. If you're unsure where to begin or what to invest in, check out my video on the best investment types. It covers various options and can help you decide what might be best for your financial goals and risk tolerance. Now, you have no excuse not to invest.